So first of all, thanks for having me. And it is a more complicated themata than most of the others are covering, because we are talking cross flows and money flows. But first of all, let's start with an example of what happened yesterday. What you see here is a chart of the Nasdaq 100. So obviously, it's the biggest stock index in the world, reflecting technology stocks. So we had a sharp up push in the Nasdaq 100, and for anybody who is invested in anything, it's very important to understand of what happens to his asset. I mean, I do portfolios, but many people do not want to do portfolios. So they will have one asset, and still they have to look at that approach, because whatever happens to their asset depends on other ones. So because it's a money flow world. Okay. Now, the Nasdaq went sharply up yesterday. You see it in an impulse. Now you have the SPX 500, which is a broader US stock index. It's actually the highest capitalized stock index on the planet, actually, and went up in the same impulse. So we see an impulse with the Nasdaq 100 going up, and thereafter S&P 500 going up. Now, it's funny enough, at the same time, so don't believe in stories which will tell you that US Treasury bonds, in that case it's the 10-year Treasury, US Treasury bonds are always inverse to stock markets. It's absolutely wrong, as you see, because the US Treasury bonds went up too. Fine. So at the same time, gold made a spike up, yet a little bit weaker than the S&P 500. And weaker than the Nasdaq 100. So how can this happen? Because obviously everybody's telling you that people go risk off, risk on, either or. So yes, there is some risk on, risk off, all theory left in the reality of today's markets. Yet today's markets are much more driven by money flows than by these components, which still are valid, just their importance is decreasing. Okay, that's very important to understand. So that means gold went up at the same time when Nasdaq 100 made a spike up. We have to just understand the reality. So obviously, what happens in that case if the Nasdaq makes a spike up and gold makes a spike up, palladium makes a bigger spike up. That's actually the biggest spike up in percentage yesterday, because the drivers behind palladium are so that if they synchronize to the drivers which drives the Nasdaq up and the drivers who drive gold up, then palladium is going to get a kick in the ass, which is a double strength, and it's going to fly in that direction. In that case, it was the upward direction. But these things can happen in the downward direction too. So if I'm talking now up or down, it's just directions. We have been a little bit early, I think, but maybe I... Okay, so how was this feeded? I mean, where did the money come from to simultaneously buy gold, the Nasdaq 100, the S&P 500, US Treasury bills, and palladium? Yeah, it came from a little down spike in Bitcoin. That means it was enough that there was a little de-investment in the Bitcoin to feed, with that money going out of Bitcoin, feed all those spikes up. So that might not please people, but it is like that. That means that today money flow is an open money flow, and like if you have the lake system in the US Midwest, it's the same. I mean, the lakes are connected, and if you please it, if you like it or not, the water levels have an influence to the other water levels. So if you like cryptos or not, the market capitalization and the money flow importance of cryptocurrencies today is so big that it's obviously able, in both directions of course, and in different constellations, to feed all those four monies, all those four other markets for a spike up, if just people going a little bit out of Bitcoin. Of course, this works in the other direction too, okay? It's just that we understand reality. I know, and I'm maybe the most disliked speaker or writer in the scene, that people don't like to hear it. But I mean, you're going to be happy in your life if somebody tells you the truth. And it is the truth, obviously, and provenly, so it's not going to be different. It's going to be worse. So how, not for me, but for people who say that cryptos don't belong to the financial market, effectively they're here. You may like it, may not like it. Or I'd say, I think people who say what I don't like, I don't watch, It's like if a small child is saying, Mama, I'm invisible. Okay, fine, but just you do that, you're not invisible. You just don't see. That's the actual situation which you buy yourself when you do that. Okay, now let's come to the actual presentation. We are actually portfolio builders. I'm also a certified money manager. I'm a certified fund manager, but I'm doing mostly big fortune wealth management. And big fortune wealth management, as you can very, very simply understand, would not like to have their gold deposited in a depository bank, which is mandatory in the case that you invest in a fund. So that means all the official functions with ESIN, with licenses and so on, we fulfill them, I have them, and clients more and more don't like to use them because they like to have the gold at home or in their own, well, okay, their own storage, right? So we are therefore switching from a classical asset management company, which also does a lot of indicator research, we are switching more and more to a family office, full service provider company, because I also advise people which are bigger investors not to invest in my funds. It's absurd, but I do, because I'm an honest person, and I say it's better if your gold is at home. Because we have gold in a portfolio, we have cryptos in a portfolio. Stuff like that you better have in your own hand than in the hand of a fund, even if I manage it. So that means we have the official nice things with ESIN, yeah, with all the blah blah registered for the smaller people, not for the bigger ones. For the bigger ones, we go multi-family office. That's basically, but this comes from the asset. It's not my direction. I just accept what the market tells me. And in that case, it's the security, it's the counterparty security that bigger wealth holding families or companies just have. I do not consider, and I will say later on why, to put that in funds. So, okay, good. So we have developed over now it's 15 years, a complete new set of superior indicator technology. Part of that you can see on real-time feed channels like Internet TV, which we dispatch. That's the basic product in our company. So before you can even invest with us or we tell you what to invest, we mandatorily ask people to watch that so that they can make their decision themselves. It doesn't mean they really have to do it, but it means they have to know what's happening. So we do not like, except in funds, we do not like passive investors. We accept that investors not going to sit every day, a whole day over a computer, but we want investors who know what's going on. So that's a strange approach, I know. The approach is uncomfortable for me. It does a lot of chaos. I got 5 cars, I'm employed in 4 companies, I own 15 companies. It's a total chaos, but it is reflecting the need of the market. It is reflecting the need of the client. The client needs in such a world, and it's not a funny world, needs to have the assets in his own hand, and he needs professionals who do it for him while he has it in his own hand and he doesn't give it to me. There is no trustee function. That reflects a little bit of work from the investor because he has to know more than if you just passively tell me, Chris, I give you the money, do it. Huh? Okay. Now, we're starting with the first example, like we did start before with the example of money cross flows. So one of our greatest invention is very precise, deflationary, or you may call it, whatever, crash detecting indicators. Important here is the date. Sorry that I had to clean up the email addresses because that's email addresses of my biggest clients. We are talking Monday, February 24th, 2020. There's coming a heavy red warning of a deflation shock. Okay? It's in German, but doesn't matter. So it's a very, very heavy warning. It's the last stage warning of a deflationary shock. All my clients got it. All my clients did prepare themselves. You see here charts, what happened afterwards. The red timeline is the timeline when this email was sent out. Okay? This was not the first email. There was preparation emails with saying, this is cooking bad. Look, this looks very bad. We are approaching a deflationary shock. Prepare yourself, and you will get the final execute fire now email alert later, which was this email. So I will not bother you with 20 emails before. Okay? Now, you see this red line, which reflects the timeline, and you see what happened later on with the SPX 500. So if somebody who did use our signal would have avoided 11.55% retracement in SPX 500. He would have avoided 6.4% loss in gold. He would have avoided 46.8% on the oil price. That's 46.8%. You know? So that's substantial. He would have avoided 32.8% loss on the German DAX 30. You also start to understand what is more dangerous. You know? Just see that, okay? So gold is the least dangerous in a deflation. It doesn't mean it goes up, okay? Yes, so that means that stuff is working. Because that stuff is working, of course, we include it into our portfolio building. In that case, it would be a hedge. So this is too late to restructure a portfolio. A deflationary shock also doesn't need that you restructure a portfolio. It just needs that you are prepared days in advance, which we do. And then you are ready to fire. It's just in the US Navy. I mean, all men on deck comes several days before. And at the end of the day comes the fire. A fire means whatever you like. I mean, I advise to go short with futures for a short time against your own assets. You're going to protect them completely. So that means if you have, for example, 1,000 ounces of gold, you get such a measured, you go 10 GC, CME GCs short, finish. So and that means you did actually, in that case, lock your gold price. Gold price goes down and your future goes up, and you're going to sell the future position immediately afterwards. So you're not going to use a future instead of physical gold. This is bullshit. I agree with everybody else, but you're going to use it in that case for 2 days, right? Because it's fast, it's cheap. Yeah, and a deflation like this, such a deflation, that's oil, doesn't merit to change your portfolio. It makes no sense. It is because of another factor everything went down. Okay, so it makes no sense to change a portfolio. You can only do something with futures. Okay, that's the first thing we do. I will come to the theory later. We also do baskets of precious metals. What you see here is a chart of our precious metal basket that would be in our portfolio, the sub-portfolio A. Sub-portfolio A has in our portfolios a weight of 37%. So if I'm building a portfolio for a wealthy investor, 37% are precious metals total. Sorry, I have to say it, mines are not included. We consider mines as being stocks, not as precious metals. That means that's precious metals physical, okay? So 37% is those precious metals physical. We mix gold, palladium, silver, and platinum. Accordingly to my index, the changes are not very often. And this is the performance since 2010. Okay, there's a performance in euro, which would be the red line, which is important for mom and pop. Yeah? For a professional, what is important is the performance against gold alone. So the blue line would reflect the performance of that portfolio, which includes gold, against gold alone. And it's heavy. We did beat gold alone by 150%. So by holding gold, silver, platinum, and palladium, we managed in 15 years to beat gold by 150%. And even in the basket, the biggest stuff that we have is gold. Okay? So that means, obviously, we understand something very, very well, and that's cross ratios. We did beat the euro by, I don't know what, 300% fine. But it's not the goal. This happens on the sideline because everything went up. But a professional, which would like to have me allocating $500 million in precious metals, is not going to ask, was this up against the dollar? It's going to say, you have 4 physical metals and you beat gold. Yes, I beat gold. That's what is interesting for a professional, not that you beat the dollar. Okay? So, fine. Now, some examples. You see now that's a certificate tracer. We did it for an insurance company, which followed those 4 physical metals. I strongly advise you not to buy it. You are not an insurance company. You can buy physical metals. Don't buy a certificate tracer. Okay? Senseless for you. Okay? Just we do it on purpose. So somebody wants it. It's an insurance company. It's not allowed to have gold in their own world. Okay, we do it. Fine. No. Just an example. We are not ideologists, as you see. So, okay. Yeah, green, 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 fine. Fact is, that's not a way how I hold physical precious metals. But if somebody wants to, an insurance company can't do differently, we do it for an insurance company as an AMC, Actively Management Certificate. Good. So the basket allocation is not really important. That's a global macro fund, which also has our stuff inside. Don't buy it, except if you are not allowed to hold physical metals yourself. Okay? That's only for institutions which are not allowed to buy the real stuff. Okay? That means it's mini. It's less than 1% of what I manage is in officially managed funds or certificates. Because I personally advise everybody not to buy it. Okay? No. I would advise every insurance company to buy it, but never a private investor. Okay, now we come to a different set of indicators. Now it's gonna get more funny. I don't know if everybody here knows what is Goldzeiten. Every German speaker knows it. Goldzeiten is basically the size of Kitco almost in the German-speaking world. So it's smaller than Kitco because the German-speaking world is smaller than the English-speaking world. But it's really a standard stuff, okay? So, and we have databases. I did program and algorithms in databases which are able to predict also overflows and magma eruptions. Oh my God, what is this? So, I mean, I have to anyway tell to everybody, you did learn it in geography, we can never on this planet build something on solid ground because the solid ground is floating on magma. Fine. So, okay, if you talk about financial markets, magma can be detected, magma pressure can be detected, and magma can be ready to break out. Okay. Now, I was absolutely keen, did risk my reputation, right? And did write here, Alarmstufe grün. That means green alarm for gold. It was on the 2nd of May 2021, sorry, with a bearish chart, a horribly bad court report, and even my own first category geometrical indicators saying sell. Okay. So how can I, against my own first category indicators saying sell, say alarm green? No, alarm green is not a buy signal. Alarm green is an alarm. And alarm, I will then tell the difference between an indicator and an alarm, okay? You saw the deflation shock was an alarm. Okay. Now this is a green alarm, but it is an alarm because many investors may be, you know, in their actual workflow, they're pre-selling, a mine is pre-selling, maybe it's merchandise, right? Maybe it's short of its own merchandise, it can happen, or a portfolio investor did overhedge gold or whatever, for good reason, or not for speculation reason. And I have to give him an alarm. And the reason is good because we have been a sell indicator was valid for gold. Huh? Still, down was magma. So I have to tell to people, if I can detect magma, there's magma. So, and that means that's gonna erupt. Okay, so everybody, I got dislikes like hell. Yeah, I said green and I put the sell signal. This is again the second, the fifth. No, pardon. Yeah, no. This is the 2nd of May 2021. That happened next day. Gold price broke out of nothing. Nothing. Yeah? No preference, no investor buying, nothing, because there was magma. So I will now explain what this is. Or you have questions to it, but sorry that it's complicated. It's like that. No? That's on the 3rd of May. Okay, now, trying to have a model for the concept, which later on was then put into databases and algorithms, the model which is mostly there would be a reservoir. Okay? So now we see here a lake on a reservoir on the left side. And on the lake is waves. So these waves would reflect what you call buy or sell signals, which you can cover with normal indicators. It also would reflect what an asset is rising against another asset. So for example, gold goes up on the wave and the Bitcoin would be down on the wave, or gold goes up on the wave and the Dow Jones is down on the wave. You could say, okay, fine. Yes, this asset is bullish, this asset is bearish. So it's reflecting the wave. But unfortunately, there's another concept, because we're living on magma. Our solid ground just looks like solid ground. If you build your house, you build it on a solid ground which is floating on magma. Okay, sorry, again, it's like that. So, and the point is that the whole surface of the whole lake can rain out. And that happens if you open this one. So a deflation shock is not a correction. A deflation shock is not a retracement. A deflation shock, if you correctly call it like that, is if the water rains out of the lake. Now, if the water rains out of the lake, it doesn't mean that the waves are stopping, as we saw at the start. Because what's up on the wave is still being higher than what's down on the wave, but the whole lake goes down. This is a deflation shock. Now, everything on the financial market has two sides. There can be the opposite, because let's assume that under this reservoir is another reservoir, and if this happens, the other reservoir has the opposite. That means that the water goes in. Okay, that would be a green alarm. So this is the visualization. This was a red alarm for this lake, and the green alarm for the lake underneath. So that means it's a second category of a buy signal, but it's rather a green risk than a buy signal. You can interpret it as a buy signal, but you don't know exactly when. You just know it's not going to go in the other direction. This is what you know. Okay, now we come to the money theory behind it. I'll try to be short because it's really complicated, yeah? And I assume on this fair and on other presentations you heard a lot about national bank money printing and I don't know what, which is true. These people who tell you that are experts. It is true. Yet, we have to put it into a complete formula to understand in what it is relevant. Now, you print money, fine. So with printing money, you're going to influence the M0, the M1, maximum the M2 if you include long-term deposits. That's what the Fed was doing. Still, in order to get an M3, you need a credit multiplier. And that means, I make it simple, you put $100 to an American bank. The American bank, because it got you $100, can issue maximum of 9 times loans of $100 to other people. The other people, let's assume, take it away from the bank account. So there is 900 new dollars, and your 100 are gone for the moment. I'm talking circulation, right? They're gone. So what's happened? We have 8 times more dollars than before. What is 8 to 1? 8 to 1, ladies and gentlemen, is exponential. In order now that, for example, and I'm talking only about the credit multiplier here, in order now that, for example, those people would pay the loans back, the 800 available circulating dollars would get 100. 800 to 100 is hyperbolic. It's not 10% less. It's 7/8 less. This is the reality about the x-axis on all our price charts. So old-style gold bugs are right because they say it's the dollar which moves more than gold, yes. But you have to also get modern, like I try to do, and to get an idea of the emphasis how the dollar moves. The dollar is hyperbolic in its quantity availability like every other fiat currency, whereas gold is variable. So that means gold compared to the US dollar is a grandma, okay? And the US dollar is the hottest asset with the riskiest stuff like any other currency. It's even better than other currencies, by the way. I don't want to say the dollar is bad, yeah, right? You have no idea how unstable fiat money quantity is. And we are not even at the X, we just M3. It's getting worse. Now you have the circulation velocity of money. Now let's assume that this $8 or the $800 or the $100, doesn't matter, are spent 8 times per day. So if it's $100 spent 8 times per day, they will have the impact of $800. If $100 are spent 10 times per day, they will have the impact of $1,000. So that means the physical quantity of money Yes, it's a component, but really a small component. And the most important thing is first the credit multiplier, and thereafter the velocity of money circulation, which means that I wouldn't like to do the job of Jerome Powell. And in the last several months, I pretty much agree with him. It's a bloody different job. If you can screw only here, and you can't do much here, and at the end, you're responsible for inflation. I mean, you know what this means. Okay, so fine. Now once we have that, and which is totally hyperbolic already, we got the money impact in a currency. Now, unfortunately, the money impact in a currency is not the money impact in a country. Yes, in North Korea, because you cannot export the currency. But in the US, you can export the currency, and the dollar is heavily exported, especially because the US has a negative trade balance. That means that it's just the money impact in a currency. And you have to check, again, the regional outflows and inflows in order to come to the money impact in a national economy. And only that one, this money impact in a national economy, if you put it in relation to the goods and services available for consumption in the national economy, only that relation is a valid start of calculating if you're in inflation or deflation. So that means the shortcut everybody does is wrong. The shortcut, which is wrong, includes true components, which are not wrong. So it's how they put it together, which is wrong. Or is simplicized, that means it's dangerous. By luck, it can be right one day. By unluck, it's wrong the next day. Okay? Fine. So now, because of that, we did develop 15 years of work inside of that, special databases which can measure this money flow pressure. Okay? And I have to tell you, me and Dr. Silver and Dr. Platinum tell you that we are not in an inflation. So, we are in a scarcity. Every scarcity leads to prices increase because there's not enough goods. So in this case, what Jerome Powell says, I don't agree with him all the time. Oh my God, no. But that it's because of supply chain disruption, he's pretty right. Okay, he's right. In a classic definition, it wouldn't matter in an equation which one did move. Say, okay, there's this money, these goods. Now there is less goods compared to the money, inflation. Okay, yes. It's not wrong. But in a modern world, you would like to know because of whom of the two which did move. Okay? Even if you take the word inflation, which has the Latin influx, that means it's flowing in. Already using inflation for price increase because of scarcity would be wrong. If there is less goods, that's not inflation, that's scarcity. American English doesn't really reflect a word for it. A German word would be Teuerung. Call it scarcity price increase, whatever. Okay? So fact is that the impulse in the pandemic, which came on that equation of goods versus money, was the goods and not the money. And that's why it's not an inflation. Yet there can be a price increase. You see now a Kitco chart, which shows you that, for example, I don't like pretty much the gold-silver ratio because it doesn't say a lot, but the gold-silver SPX ratio says more. So in a phase where gold is going up and the SPX goes up, and if we wouldn't have a slight deflation, silver would go more up, but it doesn't. So you cannot check it with the gold-silver ratio alone. But if you check gold, silver, and the SPX 500, you come near to a simplified truth. And this is that if gold and stocks, normal stocks, not mining stocks, gold and stocks go up, silver should go up more. If it doesn't, it is because it is depressed by deflationary pressure. Deflationary pressure is decreasing. I agree with everybody else. Just they say inflation is skyrocketing, and I tell you that deflation is just decreasing. So that means we agree on the way, yeah? Okay? But it's not inflation yet. because the velocity of circulation is too low. It's dramatically lower than before the pandemic. Yes, the money supply, the primary money supply is much higher, but what you have of a car which has 600 horsepower and doesn't move, right? So a car which has 600 horsepower and moves in the first gear is actually making less miles than a car with 1.2 liter motor which goes in the sixth gear. It's like that. In the car, in the money, wherever. Okay. So, fact of the matter is, we are maybe coming out of deflation now. Maybe. Not even sure. So, again, let's assume what is money again. When cash is basically forbidden, I mean talking about higher amounts, money is a receivable against a commercial bank which is guaranteed up to 100,000 euro, or in the US, if you use it with SAC, guarantees maximum to $1 million, and the rest is your risk. So money, therefore, is a fiction and a receivable. It's not an asset. It's very important. Yeah? And because it's not an asset, it doesn't react like conservatives would tell you. It doesn't mean I'm a socialist. It just means I'm not a conservative. Because in that what you see here is a chart of the day when the US Federal Reserve said that it's going to taper its buying program. Okay? That means it's not going to buy 80 million of treasuries per month anymore and 40 million of mortgage debt, but it's going to reduce it by 10 million per month on the treasuries, by 5 million per month on the mortgage debt. So, now, think conservative. This means what? Conservative? This means the dollar is a little bit more harder, right? Or not? You print less, it's harder. You have a chart of the dollar against the Japanese yen. What happened at the decision? The dollar went down against the yen like hell. Why? Because the dollar went harder, right? Because you print less. So, now maybe with this chart, we can understand what the dollar is. It's not a value. It's a party ticket. You take a ticket to enter a party. Japan did not taper. They buy everything. They have a debt to GDP ratio of 280 or something that goes through the roof, doesn't matter. That means the party is unspoiled. In the US, Jerome Powell, poor guy, had too much pressure, so he did start to spoil the party. So now it's easy. We are all young people here. We like to go to discotheques which are funny. So, now if somebody spoils the party, we don't buy the ticket. We sell the ticket. That's what happened here. They want to go to the party. They don't want to be in a boring room. And that's the reality. Print less, spoil the party. Of course, it's relationary. That means if you print less and everybody else prints less too, then the old relation is valid again, right? But as long as somebody does the party, nobody wants to go to the boring discotheque. So the dollar went down on the decision to make it harder. It's proven. It's not my theory. It's fact. Okay. Now, what is being tapered here? It's not money printing. The Fed did buy 80 billion, US treasuries per month. That's not much compared to the size of the treasury market. And outrageously high 40 million of mortgage debt per month, which is a direct communist Keynesian subvention of the US real estate market. So that second component has nothing to do with fighting inflation, deflation or crashes. It was a Keynesian finger in and putting home prices higher, nothing else. Which means, once you taper it, you're going to create a risk in the bubble that you did create. And the bubble is not in the Nasdaq 100. It's in the US home market. Because the Nasdaq 100 was not bought by the Fed and tapered now. But US mortgage debt was directly bought by the Fed and tapered now. And what happens to your receivable against the bank, which is money, if the bank is loaded with real estate debt? So, well, you'll be an astute investor and assume you're a billionaire. And in your portfolio, somewhere in a corner, is conservative asset which can't change much anymore. So it's not Google. You have Google, I have plenty of Google. But you have a conservative asset which can't change much anymore, like a gold bar. Or 50 villas, stuff like that, okay? And you grasp what's happening here. Somebody spoils the party. But he's asynchronically spoiling the party. He's spoiling the party extremely in the direction of the homes, which were before extremely pampered, right? Just put up artificially. So, within your sector of your portfolio, and I advise this to my clients, you should heavily switch from homes to gold. And that happens. That means gold is getting money inflows out of its biggest competitor of gold is the home real estate market, not stocks. Okay? Because it's getting more dangerous. If the Fed did create a bubble with 40 million, I don't talk about 120, but 40, and now starts to tap at the bubble. And this is why, and other reasons, also drivers, that gold is getting, for me today, and yesterday I told it to plenty of people when we've been standing at 1850. There is a next alarm green for gold. Okay? We will see if we get a buy signal, which is the second category of indicators that we have, but it's an alarm green. And ladies and gentlemen, an alarm green doesn't do these things. Alarm green, once it opens, makes this. Just to be sure. Okay? Now, given that drivers, there's not only magma, there's also drivers for gold, which influence the waves, are basically at the worst level that's possible. And we did make it to 1865 now, with drivers in the minus region, if one understands how gold is driven. What happens if the drivers would turn up? Because gold, if you look at RSI, gold, nothing, well, it's not overbought yet, right? But the drivers are oversold. That means everything but precious gold up is oversold. That means the sentiment for gold, not relevant in the moment. Ronnie said yesterday it's negative because the institutions don't buy. I believe him. I'm not crunching that data. But the sentiment for the drivers who put gold up is on the minimum. And it's very likely it returns. And if this comes together with the magma, which is another factor, another dimension, don't know. This stuff is jumping to 2,100 in 2 days. So I don't say that as a price prediction. I just tell you the size of the forces that are in. And I was right every day, every time. But I cannot quantify that. I cannot quantify a volcano. I can quantify the other dimension, which you have a quantification indicator here. It did say at 1801 we buy, okay, for people who want to trade. 1801 buy, okay, what did it hit? 1817 in this moment, and we are at 1865. So that I have. I got those indicators. People can buy those indicators by watching it real time. We sell that product. But this is in addition to the volcano. If this happens and the volcano erupts in the same moment, we're not on 18-something. So it might be dangerous for a gold mine. I don't say it's negative, but dangerous, because they might have oversold their product. So we provide services to such people and say, okay, you might not be interested in this indicator, but you might want to have a deflationary shock warning as we saw it, or even in the opposite, like a green explosion shock warning. It's a shock. A shock upwards is a shock. Just upwards. But okay. So I don't know what more to tell you, because it's now based on questions. It's based on what people would like to know. Several times I was asked, for example, do you have something for poor people? Because we are making big portfolios. So, okay, so last year I said, you know what, give me an Rwanda CFD account. Maybe many of you would know Rwanda, the biggest CFD provider, very big Forex trader. Simple thing, you know. Not a quality counterparty risk, but. And I did put in some stuff. I said, okay, I put it in, close it for a year. Don't look at. Okay? Was last year ago. Our portfolio is 128 items. This one was only 4. That means it's not our portfolio. It's just a very, very brief, rough, whatever, simplification. There was no trade done. We put it in and did nothing, right? So the equity is 74,000. And somebody did put in, I think, 48,000. So it should be 55% plus in 1 year. And the CFD pays rolling. That means it should be more than that. And it's not even my portfolio, it's just a macro, approximately, right? No work. Finish. That's what happens if you understand the forces. Okay? And we can offer that product too to somebody. We're not going to do it as wealth management, please, because the administration is more expensive than what a 50,000 euro client can pay, but could buy a license, right, and do it himself. Just put it in. Yes, that's it, except if there's questions. The best is maybe to note my phone number. That would be the Liechtenstein phone number. I have 6 of them, but you can call me on the Liechtenstein phone number if you want, because it's specific. I know that I'm bothering people. I know it's complex. I'm sorry for it, but I do not want to be a liar. And we did really develop and manage things which are able to come through this complexity. So we have the new monetary which works, without pretending that components which are old don't work. I mean, Kate, you know it. You know it. I gave you many things. I told you yesterday, in the morning, right? There's going to flow money from Bitcoin to gold. What did happen? Yes. Money flew from Bitcoin to gold.
Question, like, how do you track the real estate pricing? Like, what are the indicators for you there? And
well, first of all,
Zillow is selling houses under.
Look, it's very simple. You have to always go to markets. The problem with real estate is that it's 99% is off market. That means there's no current pricing for it. If you talk about equity in real estate, I still like the APTS. That's a big trust. Or if you want to go all around, if you want residential, right? And if you want to have everything, you take the Vanguard. Maybe you know that there's a huge umbrella real estate trust. Okay, but important here is not so much the equity on real estate, but the debt, because the Fed didn't buy houses; the Fed bought mortgage bonds, right? So, and there's plenty of indices for that.
Yeah. I'm just looking for indicators as well, like news items, like Zillow selling houses below purchase prices, because
that is an indicator. This is an indicator which is same valid like indicators like permanent negative interest rates. But it's the same. If you wait until you see permanent negative interest rates, you're about 8 hours behind the train. So I don't say it's wrong, again. But we're in a modern world. We're living in the 21st century, okay? Not in 1920 with Mr. Hayek or somebody, okay? So that means, yes, I don't say that gold is not positively correlating with negative interest rates. But do you really want to expose your fortune, your company, your mining company, whatever, yeah, on waiting so long to find that out? Until they really sell under prices. But I agree with you that it's a valid indicator, but it's bloody slow. Okay? It stays valid, but these markets today are machine-driven markets, which are mega fast. And as you saw at the start of my presentation, you remember this shock in March 2020. The thing is done within 15 minutes, finish. I don't think it's going to recover fast. Without Fed printing, that would stay down. Okay? So the show is over. But indicators are good. Even indicators which are valid are still valid. But what you do with it if they tell you when the show is over? Well, okay. That's it. Okay. Sorry, it's not a speech. I know it. I'm also my portfolio just at the end of the day. My portfolio is 36 to 37% in precious metals. 57% in stocks, and the rest is cryptos. Okay? I do not know anybody who has 36% precious metals. Because the majority says, look, it's like Beimischung, like 0.5 or 2, and the other guys are precious metal bucks and say I was 70% minimum. I said, sorry, 36, because that's what the money flow tells me. So I'm strange. Thanks for having me, because it's costing a lot of nerves, I know. Yeah. Yes, please.
How do you see that Basel III regulations coming in from January?
Absolutely right. You're completely right. It's a very good question. It's dramatic to the velocity factor of money circulation. Absolutely, absolutely. It can impact much more than a Fed printing program.
But for politics, I think positive.
Wait and see. Don't get too much fundamental. You are right on the long run. Okay? But still, the gold price is not going to be driven by the need because of Basel. The gold price is going to be driven by billions and billions and billions of dollars and other currencies of fortune who want to fill their box, which is the not really new product, but I want to have 17% of my portfolio in that. And if it goes out of real estate, it goes in gold. And that can you put you the gold price to $4,000 within a week. What you talk about is true. It can give you $20 per month. Is that answer fine? But those $20 would be permanent. That's the difference, okay? Those spikes go down too, okay? But today, believe me, it's money flow. Yeah? But yes, the positive impact would be, yes. But I still think that the drivers are more important, and we are at the minimum. That means it might be that several prognoses for the gold price given on this conference might be true, like $4,000 in 2030 or something. I just tell you, I'm not sure. Of course, I'm not sure. Nobody is sure. But it is possible that gold would crash to $4,700 by 2030. Crash to $4,700, because before it's at $8,000. You understand my message? Because if the volcano breaks out, it does not stop at 4.7. This goes through the roof, and then it makes bing, boom. That's possible, yes. But it's going to be like that. Yes. Thank you.
Good end. Good finish. Thank you so much.